Business ownership doesn't happen in a vacuum. It happens in real economic conditions, real lending markets, and real moments of uncertainty.
Rising rates, tighter capital, government shutdowns, and suddenly financing a business isn't as straightforward as it used to be.
Today's guest lives at the intersection of it all. Shay Kleinschmidt, VP of Lending at FranFund, joins us to break down what today's lending landscape really looks like.
From early default rates to smarter underwriting, and why liquidity after closing matters more than ever.
If you're considering franchising or business ownership, this conversation could change how you prepare and how you protect yourself.
I'm Sara Waskow, and this is my colleague Roxanne Rapske. Welcome to episode 113 of Unpredicted Entrepreneur. We created this podcast to bring you information and education about everything franchising and business ownership. So, Shay, welcome to Unpredicted Entrepreneur. We're so happy to have you.
Thank you.
Roxanne and I realized that it had been a long time since we had a funding update. So as we mentioned, you are the Vice President of Lending at FranFund, one of our funding partners. A lot of people ask if our companies are affiliated because our names are so similar. We are FranNet, you are FranFund, and we are not affiliated, but longtime partners. So thanks for joining us today.
Thanks for having me.
And you're right here headquartered in Fort Worth, so local to us all. So let's just dive right into what's going on in the lending environment these days. I know you stay very busy because nothing is ever a dull moment for you, right?
Oh, correct. Part of why I love lending.
Yeah. Never
Forever
boring.
changing.
So let's just get started on kind of what trends you're seeing and what prospective business owners might need to know about the lending environment.
Absolutely. So I'll start with, what forecasters are saying. So they're calling for a moderate growth year for our economy. And although that doesn't sound very sexy or exciting, it is growth. And it's also a very healthy backdrop for business. So a steady paced economy typically looks like consumers are still spending, businesses are open and operating, and cash flow is present. And that type of stability really helps keep credit demand healthy. And more importantly, businesses are typically able to cover their obligations, which in turn helps reduce broad-based default risk and keeps lenders active in providing capital. So I think an important point with that is, what does that mean for franchising? Well, the good news is franchising doesn't need a booming economy to thrive and succeed. In fact, historically, typically, franchising can outpace the GDP in the US. So I think we'll continue to see aspiring business owners. There's not going to be any halting of the pursuit of entrepreneurship, but I think that they will be more intentional in how they achieve business ownership. And franchising offers such a compelling path because it offers both independence combined with structure. Mm-hmm. And so I think that, again, it's not going to slow down entrepreneurship, but I just think it's going to require owners to look for smarter paths forward. And I think that puts franchising front and center.
Well, with that said, we're on the tail end of the longest shutdown in history for SBA lending, right?
Yes, 43 days.
43 days. So, and then rates seem to be coming down, right? So, do you think rates will, I know it's hard to say all this, right? But do you think rates will continue to come down? Any future shutdowns? Like, with that moderate growth, are you seeing anything else that you can talk about?
Yeah. So I'll start with the Fed rate. So everything that I've been reading in the updates that the Fed has been putting out kind of hint to a slower reduction of pace. And so I think we will see more rate cuts this year, but I think it will be slower as they work to really, balance the cooling labor market and also inflation. Yeah. And so I would expect, based on what experts are saying, about 1 to 2 cuts coming soon. The wild card is that Fed Chair Jerome Powell, his term ends in May. So it'll really kind of depend on who fills that seat on what the remainder of the year will look like.
Fingers crossed.
So we'll see.
Yeah, exactly.
And then to bounce over into the federal government shutdown. So that was the longest in history. And a little fun fact with SBA, it halted about $5.3 billion, which affected 10,000 small businesses nationwide. So it can have a big impact even over a short amount of time. We're seeing lenders still kind of working through those delays, but they are fast paced getting those loans closed that were delayed. And I think we'll see them get back ahead and back on track this quarter. Now, that is, though, if there's not another government shutdown coming up on January 30th. So what happens in the lending space in SBA during a government shutdown is that the SBA cannot process new loans. So lenders that are SBA approved to approve loans within their own financial institution can continue to approve and work towards closing. But if a franchisee does not have an SBA loan number, which kind of grandfathers them in to being able to get funded, then they can continue to work on that closing checklist, but they can't get funded until it reopens. And an SBA loan number, for those that don't know, it's provided after the SBA loan is officially bank approved and they have all their final contracts. There's a final loan amount in place. So ultimately, there's not going to be any assumed changes that are going to be needed. And if any changes happen, maybe, well, I thought construction was going to be this, but now actually it's going to be a bit higher, or my lease ended up falling through, that SBA loan number is voided and they have to get a new one.
Okay.
Oh, interesting. Okay.
Yeah, it's kind of the backlog there. And what I've been reading in the news, I mean, there's still a lot of bills that need to be passed for us not to get in a shutdown, but we just never really know if they're going to make it or not. And the two biggest budgets being defense and healthcare are still not decided on yet. So,
well, when this
We'll see.
releases, I guess we'll have an answer, because this is probably going to release after January 30th.
Yes, yeah.
It'll be fun to look back on this and see what happened,
Right.
actually.
It'll sound like old news by the time it's released.
It might. It might. So you had mentioned that the early default rate has increased since 2023. So tell us how that's kind of impacting things.
yeah, so it is definitely causing some shifts in the lending landscape, which we can get into later. But essentially, an early default within the SBA industry means that a loan that has been fully funded defaulted within the first 18 months.
Okay.
And since 2023, that rate has increased over 200%,
Wow.
which is huge because that means it's even greater than it was during the COVID pandemic, which is kind of wild to think about. And so it really drew a lot of attention to the negative impact that the 2023 SOP, which is the standard operating procedure or hundreds of pages rule book that the SBA lenders have to go by. In 2023, under the Biden administration, they made some changes that had negative impact, like they increased the small loan program from $350,000 to $500,000. And on top of that, they lifted a lot of the guardrails that lenders really relied on for many, many years to have prudent underwriting standards. So perfect kind of mix of chaos, and you have some bad lenders in the mix, and defaults just started going up. You're also seeing a lot of loans that were funded during the COVID pandemic start to default because now that, you know, for after COVID, rates started increasing and you have inflation and all these other things happening. And so this is kind of the impact that we're now seeing. So what that has done in the lending landscape is it's causing lenders to really kind of restructure how they're lending, who are they lending to, and over what conditions or under what conditions. And so we're really seeing, you know, credit becoming or capital being more intentional. So we're seeing capital tighten, but that's really the healthy shift that we need to get default rates back down. And so lenders are just be going back to smarter, more prudent underwriting. They're wanting to see in the franchise space clear proof of unit level profitability. And they're also just really working to reduce failure and fraud. And I know we've all seen in the media the very heightened federal oversight that's happening across all kinds of different programs. And it's no different for SBA lenders. So just another reason for them to be more cautious.
Is this part of why they brought back the SBA directory for
Yes.
franchise?
That is one of those guardrails, but also that really helped lenders focus on more important things in the loan file. And so it helps make approval decisions quicker and more streamlined. And they're focusing more on other things about the brand, like their profitability and things like that. And then also the borrower strength, without having to hire attorneys and other incur other costs to determine whether the brand is eligible.
So that doesn't fall on the underwriter's lap now,
Right.
to go through that franchise disclosure document and franchise agreement, because there's the SBA directory.
Correct.
So let's talk.
It's a franchise directory, right? Where all these
Yes.
franchises are listed because they've already been vetted, right? So the
Yes,
banks are not
to
having
get on
do
the
that. To get
directory.
on the directory.
Yeah.
That's what I thought. Yeah.
Yeah.
Yep.
So let's talk about the requirements to get on the SBA approved directory.
So you have to provide basically anything that the franchisee signs. So the most up-to-date FDD, the franchise agreement, and anything else they sign, I would include, just to be careful. And then there's a new document called the franchisor certification, and it ultimately replaces that SBA franchise addendum that they had to submit with every loan back in the day. That has to be part of the deal too, signed by the franchisor, basically stating like they're agreeing to all of the eligibility conditions in there, signing off saying, yes, we meet that, we meet that, we meet that. And it needs to go to franchise@sba.gov. So it is first come, first serve. There's no expedited process. And it should go directly to the SBA to really avoid any delays. And for brands that have been on the old directory, they're still on there, but they have until June 30th to be recertified. So they still have to submit the same information as a brand that's never been on there before. And for new brands that haven't, there isn't a deadline. But we're hearing that it's currently taking up to 3 months or longer for brands to be approved. So I would get it in as soon as possible if you know your franchisees are going to need SBA funding.
Okay, so that's what I wanted to clarify. Like, I'm a prospective franchisee looking at a brand. If they're not in that SBA franchise directory, they would not be eligible to get an SBA loan, correct? Okay.
And what's a terrible scenario is when you have franchisees that are all the way up to, okay, I need my money, I'm at loan closing, and the brand's still not approved. So they're just sitting. And so there are some brands that I've heard that applied in June of 2025 and they still aren't on.
Wow.
On the
That's
directory,
longer
which is
than 3
wild.
months.
Yeah.
And the SBA is updating it weekly. So don't just save the directory on your computer. I would pull it from the website every time. And it is public, so anyone can go to it. And if you're a franchisee or a franchisor and you want to learn more about it, you can just Google SBA franchise directory and go to the SBA's website. And they have that email address I talked about, the requirements, all the information needed on there.
Okay.
Very useful information. Thank you.
And one more question. What happens if you're a newer emerging brand? Where is there like a cutoff that you have where you look at these franchisors more stringently, number of units, and then what happens if they fall beneath that? What does that look like?
Great question. So because of where we're at with default rates, lenders are paying even closer attention to the brand. And then if you're an emerging brand with less than 25 units, especially less than 10 units, not only is your brand going to be scrutinized on a deeper level, but also there's going to be a smaller pool of lenders that lend in that space. It doesn't mean the emerging brands can't get their franchisees funded. I want to make that very clear. But you need to be bringing in the right franchisees. So franchisees that are going to operate under emerging brand need to be prepared to potentially provide higher equity injections, more post-loan close liquidity, meaning money still in the bank when the loan is closed after they've paid their down payment and other costs needed to satisfy the equity injection. They could have to provide personal collateral. And then also banks may be offering less favorable terms. So the bank may be coming in with a max rate because it's simply a higher risk deal and things like that. An emerging brand, really, there's no established proven track record yet in franchising. They may have great corporate units and the founder had great success with the units they have open, but as far as franchising goes, there's not a lot to go off of. So I would be prepared to provide lenders more information if they need it, whether it's corporate financials. If they have one franchise operating, can we get a P&L on that franchisee's profitability? So they just have more information to go off of. at FranFund, we're actually implementing a emerging brand kind of onboarding form. So we're taking all of the questions and things that we're hearing lenders need, and that way we're being more proactive. So it's not delaying their franchisees later in the process to have to go get that. And one more thing I want to bring up, and this isn't something that everyone will agree with me on, especially not franchisors. But lenders really do look at how responsible are they being in their growth pace. So if you're an emerging brand and you just sold 100 units in your first year and you have 2 operating or whatever, lenders don't necessarily like that. And lenders have their own kind of max on how many of those new brand or new units they want to take on, because they don't want to fill their portfolio with a brand they don't have experience with yet that's brand new to the industry. And then if those start negatively performing, they have a huge chunk of their portfolio that now they have a significant loss. So they may say, okay, we've done 25 of these. We're going to put a pause. We want to wait a year and see how they perform, and then we'll open the doors back up again. So then that bank's done. Now we got to go to the next bank that may be open to that brand. So smart, responsible growth pace is important too.
That's a big deal, because we've seen that a lot, where you get these new brands, they've got 100 units sold and nobody's getting open, and you're thinking, what's going on? So especially if it's, it takes longer if you have to sign a lease and build out a space, but it's still, after the first year, you should still be getting some units open. So that probably is very prudent.
Yes.
And the thing that I like to mention is that banks are businesses, and they all have a different appetite for what kind of business they want to do, right? And the reason to come to a FranFund, and the reason we use you guys as partners, is because you have relationships with so many different banks. I don't even know how many, but you can look at a borrower and look at a brand and kind of have an idea of which banks might be the ones to lend on that. You'll shop that loan for them and then come back to them with the best terms, instead of them having to run all over the place and try to find a lender that's going to lend to them, right? Did I miss anything on your
Very
wall?
well done. Yeah. So if we're even ever unsure about, our lender's going to be interested in this type of concept, or maybe there's some flaws in the FDD, maybe they've had some litigation and bankruptcy or some terminations, whatever it is, we'll pre-shop it to lenders and make sure we have lenders that want to bank that brand, those brands, franchisees.
In case we didn't mention this, the FDD stands for the Franchise Disclosure Document. So
Right. And every franchise has one. It's required by the Federal Trade Commission. And just one more thing that you mentioned with emerging brands, and you said FranFund is kind of developing, did you say a checklist or something to kind of help prospective franchisees as they prepare their loan? That's not anything that they're going to get if they're just going directly to a bank either. So there's a lot of value in what you guys can provide to get franchisees ready to submit their application and work on getting their loan.
Yeah, I think there's a misconception that you can just go into your local lender and get a loan. And the problem is that a lot of banks, especially the big institutions, don't do startup lending because it is higher risk, especially if it's under emerging brand or a less established brand. I think the last time I looked at the stat, it was around like a 32% approval rate if you just walk into your local bank. And then again, a lot of these banks don't understand franchising either. So it's a slower, more complicated process. They're asking a bunch of questions. Maybe they get you all the way through to the approval. Then they go, oh, we can't do this because you're a franchise. You're like, you knew that when I walked in the door. So it can be a waste of time. So yeah, we work really hard to onboard lenders that are very active in the SBA space, but also are true franchise experts.
Yes.
Wonderful. So what would be a good tip for someone who's looking to buy a business and potentially thinking they might want to get an SBA loan? What are some tips that you can give prospective borrowers?
Great question. So do the unsexy work, do your homework, and read the FDD. I know, sadly, a lot of candidates don't do that. Know what you're getting into. Definitely do franchisee validation calls so that you can get information that the brand may not be able to tell you about how it performs. Ask them all kinds of questions about their experience. And then as far as capital, if you need capital, like really understand the SBA programs or rollovers, business startups. Know what all of your options are before you just dive in. And I would definitely have funding conversations early on. Don't go sign a lease agreement or something and be locked into a bunch of contracts and then go look for funding. And maybe too later you expended a bunch of money and you should have instead had this funding strategy. And so having also not only a short-term plan, but if you are looking to be a multi-unit franchisee and you're looking to expand, have a short-term and a long-term funding strategy, I think is really important.
Excellent advice. I like what you had shared with us when we were prepping for this, that the best funded franchisees are also the most educated ones. So that ties in with your tip of doing your homework and being prepared and partnering with the right people. Shay, is there anything else that we didn't ask you that you think is really important for our listeners to know about the lending environment these days?
I think just understanding that lending is fluid. It can change, tomorrow. And so just again, doing your homework, talk to experts, talk to people that have not only succeeded, but failed. And effective listening, I think, is so important. When you're in the SBA or any kind of funding process, making sure that you're hearing what you need to know, the helpful steps to get to the finish line, without, what's the word I'm looking for? Without like going out of compliance. So, I didn't know that cost wouldn't count towards my equity injection. And now I wish I didn't spend that. And now I don't have enough money to get to the finish line. So just doing your homework, listening to experts and effective listening and knowing what all your options are and staying in contact with the news, like listen to the news and everything going on, but also don't trust everything the media is saying, because franchising really is resilient and we are on a different path sometimes than where our economy is, in a good way.
Well, and you reminded me of something, because back in the day before my franchise career, many moons ago, I was in lending on the mortgage side, but there's nothing worse than getting close to closing and your borrower went out and purchased a car, or made a commitment with a payment. And now this loan that was once approved is no longer approved. So based on what Shay just said, don't go out and make any major purchases. Talk to your underwriter first. If you have loan approval, don't do anything until your loan closes.
Right.
So glad you said that. Yeah.
Things can change. I mean, until the money's in the bank and that loan closes, they have the right to change their mind, the lenders. So
yes,
important fact and detail to remember for sure.
Yeah. And the other thing is, one of the ways that people will fund a business is they'll tap into their home equity line of credit. And if you're thinking of leaving your job or you're going to be getting laid off and you would like to place a home equity line of credit on your home, do it while you still have a job, because you can't get one if you don't have a job.
Right. And I think we're seeing more kind of creative equity strategies. So people are kind of capital stacking. So more people are doing the rollovers paired with an SBA loan, or maybe they're doing an SBA loan, but they need additional liquidity. So they want to tap into their home equity. Yep. And I will say too, especially if you're looking at multi-units, that sometimes your home equity, if you have other options, you should keep that in your back pocket.
Yeah.
It's kind of a rainy day. Okay, my business isn't cash flowing as quickly as I wanted it to, but under the franchise agreement, I have to open my second one coming up. Well, now you don't have to wait on qualifying for a lender. You can go use your home equity or cash that you didn't have to spend because you utilized that on the first one. Yeah.
It can just sit there for years.
Exactly.
And when you need it, it's there.
That's the great thing about a line of credit, is it just sits there until you need it and you don't ever have to use it and you're not paying interest. But if you do need it, you've got it.
Yeah.
So excellent. Well, Shay, thank you so much for taking time out of your day and joining us today. If somebody wants to get a hold of you or someone else at FranFund, what's the best way to reach you?
Yeah, visit my LinkedIn page. I would love to connect with you. And then that way I can ensure too that if I'm not the right person, I'm connecting you with the right person to assist you with whatever you need moving forward. And then also our website is franfund.com. If you want to talk to a funding consultant about any of our loan programs or be a referral partner or whatever it may be, all of our information is there.
Excellent.
Perfect.
Thank y'all so much. This was fun.
Thank you for joining
It
us.
was fun. It was fun. So if you're interested in learning more about franchising, funding your franchise, if you'd like to connect with Roxanne and myself, please click on the links in the description below. Thank you so much for joining us, and I hope everybody has a great day.
Bye.
Bye.